Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen. I'm a chartered professional accountant located in Oakville, Ontario, Canada. My mission is to become the Google map for hardworking Canadians seeking financial freedom. Now, as all of you might have heard about lately, Bitcoin and all the cryptocurrency have been consistently in the news. A bunch of my clients are investing in cryptocurrency, and they've been coming to me to ask me about the tax implication of trading or holding crypto. And today, I'm going to use this video to explain to everyone the tax implication of trading Bitcoin, mining Bitcoin, as well as owning them long term or trading them for goods and services. Before I get started, if you have not done so already, make sure that you hit the like button and subscribe to our YouTube channel so then you can stay on top of the latest tax tips. Now let's get started. There are many different ways to invest in crypto or use crypto in general, and each ways of investing or using cryptocurrency would yield to different tax implications. Some people like to buy low and sell high and take advantage of the hyperinflation and take advantage of using crypto to make extra cash flow. So they choose to trade cryptocurrency on the public exchange. Some people, on the other hand, believe in cryptocurrency and believe in the concept behind it, and they decide to purchase them to hedge against inflation because governments around the world are printing endless amount of money to pump up the economy. And cryptocurrency is generally regarded as a way to hedge against inflation. Some people purchase equipment, computers, software, hardware to mine cryptocurrency. And in exchange, they would get coin, Bitcoin, or Ethereum, depending on what they are mining in return. And other people use crypto just to pay for goods and services. And I know that there is a gym in Toronto that are currently accepting crypto in exchange for the services that they provide. So some people use cryptocurrency to enable them to transfer large amounts of cash from one side of the world to another side of the world. Just yesterday, I saw a post that talked about a transfer of 16,000 Bitcoins, which is equivalent to $1 billion US from one wallet to another. And that transaction cost $2, just under $2 of fees to facilitate the transfer. Each of these types of investment and use of crypto have different tax implications. We will give you a high-level overview of how you get taxed on each of the scenario. As a general rule of thumb, as soon as the crypto leaves you, tax is triggered. This can mean that the crypto leaving you in public exchange. This can mean that the crypto leaving your wallet in exchange for goods and services. This could also include the transferring of cryptocurrency from your wallet to someone else on the other side of the world. Now, there are two types of tax implication: income versus capital. You can get taxed on trading crypto as income on the account of income, or you can get taxed on investing in crypto on the account of capital. What's income and what's on the account of capital? We're now going into talking in depth about it. Income is 100% taxable. As an example, income refers to business income, employment income, rental income, dividend income, interest income. These are all income. When you make $100,000 of income, $100,000 is taxable. Now, whereas on the other side, there's something called on the account of capital. What does that mean? Capital gain means that only 50% of the money that you make would be taxable. Now, for example, when you realize the profit from selling a long-term investment, long-term stock investment, it could be long-term rental property investment that you hold for long-term and you receive rental income or you receive dividend income, those are called long-term capital investment. When you realize the same $100,000 profit from the sale of these long-term investments, only 50% of it is taxable. So only $50,000 would be taxable. And as you can see, everyone would want to point their income or the profit that they make from the sale of cryptocurrency on the account of capital instead of income, because capital means that 50% of the profit that you make would be taxable, whereas if you are on the account of income, 100% of that would be taxable. How does CRA determine whether you are trading crypto on the account of income or on the account of capital? It really goes back to your behavior and what you are doing. Here are some factors that CRA looks at. Are you carrying on the trading activity for any commercial reasons? Is there any promotion involved? Are you telling the world, essentially, are you telling the world that you are buying crypto or you're mining crypto? Business plan, do you have any business plan preparation and capital assets or inventory acquisition just to prepare yourself to mine crypto? That is an example of having a business plan. What are your intentions in terms of your operation or your trading? Are you in it just to make a quick profit, or are you in it just to hedge against inflation and you hold it long term and you don't trade frequently? Are you having repetitive and regular process over time? So how often do you trade? Do you trade regularly? Those are the 5 factors that CRA look at, and some of them would point you to the direction of trading crypto as a business, and therefore the trading profit that you receive would be considered 100% taxable. Some of these factors would point you to trading crypto on the account of capital, and therefore the profit that you make would be 50% taxable only. As an example, these are 3 common examples that you are conducting a business, and it's on CRA's website. If you do crypto mining, you do crypto trading, and if you trade crypto, you operate a cryptocurrency exchange, including the ATM machine, they are all considered 100% taxable. They are all on the account of income, 100% taxable. So how do you get taxed and how much tax do you have to pay? It really goes back to converting all your cryptocurrency to the corresponding Canadian dollars. Now let's use an example to explain. Let's use Alice as an example. Alice bought cryptocurrency for $200,000 in 2016. She sold these cryptocurrency for $240,000 in 2017 with multiple transactions from timing the market. And Alice regularly traded and demonstrated trading behavior. Alice was considered a trader, and her trading activity is considered commercial activity, and therefore she had to report the entire profit, the entire $40,000 profit on her 2017 return and report it on the account of income. Now, another example, Tony bought cryptocurrency for $200,000 in 2017, same year, but he didn't sell it. He held on to it, and he only sold it recently for $480,000 in 2021. There is no transaction happened from the 2017 to 2021. He rarely traded. He only hold it just for hedging purpose. And the gain realized by Tony was on the account of capital. And therefore, he had to report the profit that he made. The profit that he made, it was about $280,000. And that $280,000 is reported as capital gain because he was not trading it. He wasn't demonstrating any commercial activities behavior. And that $280,000 has to be reported on his 2021 tax return. 50% is taxable. So $140,000 is taxable in this particular example. Another example here, now let's say Morris purchased specialized computers to mine cryptocurrency, and Morris received payment in cryptocurrency. He's not receiving payment, he's being rewarded with the crypto that he's mining. Now these crypto received is not recognized as income because he still owns it. This crypto that he received and he got rewarded it forms part of his inventory. Now, costs associated with the mining is then being added to the cost of the crypto received. Now, how would he get taxed and when would he get taxed? Well, as a matter of fact, it really goes back to whether he mines the crypto as a hobby or he mines the crypto as a business. Now, let's say Morris mines crypto as a hobby. When Morris sells the crypto that he mined, gained from sale is treated as capital gain. 50% of it is taxable. So hobbyists cannot deduct expenses such as rent, electricity as an expense, but the profit that he made from mining crypto as a hobby, when he sells that crypto eventually, he would have to recognize it on the account of capital. So the profit that he made would only be 50% taxable. Now, on the other hand, if Morris mines crypto as a business, so he's very serious about it, he rents a space, he buys a specialized computer, he got extra electricity just so that he would have enough energy to mine crypto. When Morris sells the crypto that he mined, profit from the sale is treated as business income. 100% is taxable. The good things about mining crypto as a business is that Morris would be able to deduct the rent, the direct costs associated with mining, and the indirect costs as well. He probably could also deduct the rent, electricity, also the equipment upgrade, the software costs, the hardware costs, everything against the business income. That's the beauty of reporting it as a business. But unfortunately, 100% of the sale profit would be reported as business income, and 100% of it is taxable. Now let's go into some commonly asked question. Here's one of the most commonly asked questions. Can I not report cryptocurrency trading to CRA? Well, as a matter of fact, in March, one of the most popular public exchange, CoinSquare, strike a deal with CRA to disclose part of the high volume trading activities to CRA in the past. So essentially, the public exchange is disclosing information to CRA. If you hadn't reported it, they would be able to hunt you down if you trade using that crypto platform. So essentially, using that deal, other public trading platform is following suit as well. So CRA would be able to get your records from the public trading exchange if you're not reporting it. So they will eventually come back to you. So someone asked, well, as long as I don't use CoinSquare and BitBuy, the big names out there, big public exchange out there, you may be able to get away with it. Well, I just read this publication, Pivot. It's a magazine published by CPA Ontario. I am a chartered professional accountant. It's published by my CPA for CPAs. And in its September-October issue, basically, it has a paragraph that talked about 167 counterfeit trading and cryptocurrency apps were traced to a single server as part of a fraud identified by British cybersecurity firm. Scammers trick users into downloading the app via a replica iOS App Store website. So I don't know if you really want to just go into any unknown cryptocurrency app or trading platform to trade crypto. Now, there is also a local example. A Mississauga man used a crypto trading agency he found online. He continued to trade, but every time he tried to cash out from this trading agency, this trading agency kept creating excuses and asked for more and more money to release the funds, and he reportedly lost $200,000. So you might think that you have a way to get around for not reporting to CRA, but sometimes it may be worth it to just report to CRA to use a big name out there for security reason. Another commonly asked question is, do I need to report any gains or taxes if I don't take money out from my trading platform? So let's say you buy Bitcoin and you sell it for a higher amount and you make $100,000 from the trade, and the money stay with your trading platform. So let's say it's one of those CoinSquare or BitBuy. Do you still need to report the capital gain? The reality is, going back to our rule of thumb, as soon as the coin leaves you, it becomes a taxable transaction, and therefore you would have to report the sale of the Bitcoin even though the money didn't go back to your regular bank account. It still stayed with the trading platform. And other questions that's being asked is that, do I need to report the gain trading one type of cryptocurrency for another? Sometimes you do the exchange from one type of cryptocurrency for another one. If you apply our rule of thumb, as soon as your coin or your crypto leaves you, it becomes a taxable transaction. And based on that rule of thumb, essentially, again, you will have to report the trade. So the coin that's leaving you, the crypto that's leaving you, is being disposed at the fair market value at the time the transfer happened. And so you would have to report the gain on the sale of crypto on your income tax return. But the purchase of the second crypto would then become part of your investment, and you won't have to report the gain until when you sell the property later on. The last commonly asked question is, do I need to report anything if I use crypto to purchase goods and services? Going back to our rule of thumb, when the crypto leaves you, you're disposing the crypto. You might buy crypto for $5. When it leaves you to purchase goods and services, the crypto is worth $6. That means you would have to report that $1 extra when the crypto leaves you to purchase a good in exchange for the goods and services. The $1 gain would have to be reported as soon as the crypto leaves you. Let's use an example to explain. Tim found a deal on a living room set at an online vendor that accepts Bitcoin. Tim acquired $3,500 worth of Bitcoin to buy the furniture with. By the time he transferred the Bitcoin to the vendor, the Bitcoin has risen in value by $500. So when he does the transfer, he would have realized a $500 gain on his Bitcoin, and that is on account of capital. Tim would have to report that $500 as capital gain on his income tax return. 50% of that capital gain is taxable. Another commonly asked question is that, do I need to report it if I transfer crypto from my wallet to my dad's wallet directly, privately, without the use of public exchange, or to anywhere else in the world to anyone else? Well, using our rule of thumb, as soon as the crypto leaves your wallet, it becomes a taxable event. The appreciation from the time you purchase the crypto would have to be reported on your tax return on the account of income or capital, depending on how frequently you trade and all these other behaviors that we mentioned earlier. Let's use an example to explain. Say you purchase crypto for $1,000 in 2017. And then in 2021, the crypto is now worth $3,000. And you decide to transfer the crypto from your own wallet to your dad's wallet on the other side of the world, privately, directly. Using our rule of thumb, when crypto leaves you, it becomes a taxable event. In this particular example, you bought it for $1,000. The fair market value at the time when you transfer the crypto from you to your dad is $3,000. So you essentially made $2,000, and you need to report that gain of $2,000 on your 2021 tax return. Now let's talk about the type of documentation that you would need to keep in order to facilitate the reporting on your annual tax return. Now, if you trade on different cryptocurrency as a trader, different cryptocurrency exchange have different type of standard in terms of record keeping and how long they're going to keep your trading transaction. It's always advisable for you to export those transaction and information from these exchange on a regular basis to avoid any loss of information to report your transaction. And you're responsible to report all these transactions and provide the supporting document for at least 6 years from the end of the last taxation year. Now, if you are not trading using the public platform, you're just doing the transfer, these are the information that you would need to keep to facilitate the reporting. The day of the transaction, the receipt of purchase or transfer of cryptocurrency, the value of the cryptocurrency in Canadian dollars at the time of the transaction, the digital wallet records and cryptocurrency addresses, a description of the transaction and the other party, even if it is just their cryptocurrency address, the exchange records, accounting and legal costs, and the software costs relating to managing your tax affair. Now, if you are a minor, it gets a bit more complicated. You also need to keep the receipts for the purchase of the crypto mining hardware, the receipts to support your expenses, and other records associated with mining operation, such as power costs, mining pool fees, hardware specification, maintenance costs, and hardware operation time, the mining pool details and records. Now, all of these information, you can find it on the CRA website directly. While we cover a lot today, we talked about the tax implication of trading crypto on public exchange. We talked about the tax implication buying it for long-term investment, how you would get taxed if you are mining crypto, and how you are getting taxed as well when you use crypto to pay for goods and services, as well as doing private transfer. If you have any questions and comments, make sure you leave it below so I can personally get back to you. If you find the information useful, make sure you give us a thumbs up so YouTube will share this video with more people. Last but not least, make sure you subscribe to our YouTube channel to stay on top of the latest tax tips. Until next time, thank you for watching.